When beginners first step into the world of investing, they often feel overwhelmed by the sheer volume of numbers, charts, ratios, and terminology that seem to hover around every company. Stock prices move, headlines fluctuate, opinions conflict, and somewhere in the middle of that noise, a new investor tries to answer the most basic question of all: is this company actually worth investing in? That is where fundamental analysis enters the picture. It is not a trick, not magic, and not guesswork. It is a calm, structured way of peeling back the layers of a business to understand what truly drives its value. And for anyone who wants to invest with clarity rather than emotion, learning fundamental analysis is the first step toward mastering the craft of thoughtful investing. Fundamental analysis begins with a simple idea. Behind every stock ticker, there's a real business selling real products, earning real revenue, paying real expenses, facing real challenges, and holding real potential. When you buy a share of stock, you are not just buying a symbol. You are buying a tiny piece of that business. So the natural question becomes, what is this business actually worth? Fundamental analysis helps you answer that question by examining the financial health, performance, and long-term prospects of a company. It shifts your focus from short-term price movements to long-term business reality. The foundation of fundamental analysis lies in three key financial statements: the income statement, the balance sheet, and the cash flow statement. Think of these as the heartbeat, the skeleton, and the lifeblood of a company. The income statement shows whether the company is profitable. The balance sheet shows what it owns and what it owes. The cash flow statement reveals the truth about how money actually moves through the business. Each statement tells a different chapter of the story, and together they reveal whether the company is stable, struggling, or silently building a future that others have not yet noticed. For beginners, the income statement is often the easiest to understand. It tells you how much money the company brought in, how much it spent, and whether there is anything left over. But looking at a single year is not enough. You want to see trends. Are revenues growing? Are profits becoming more consistent? Are expenses under control? A company that grows steadily over time, even modestly, is often healthier than one that spikes dramatically and collapses just as quickly. Consistency is a quiet indicator of strength. The balance sheet helps you understand the company's foundation. Does it have too much debt? Does it have enough cash to weather difficult periods? Are its assets productive or stagnant? Debt itself is not necessarily bad. Many great companies borrow money strategically, but excessive debt can make a company fragile. When a downturn hits, high debt businesses can crumble under the weight of obligations. A strong balance sheet is like a fortress that protects the company during storms. Then there is the cash flow statement, often the most overlooked yet most revealing document of all. It shows whether the company actually produces real cash, not just accounting profits. A business might look profitable on paper while bleeding cash in reality. Cash flow reveals whether the company can pay salaries, invest in growth, pay dividends, and survive tough economic cycles. Positive, consistent cash flow is one of the clearest signs that a business is genuinely healthy beneath the surface. Once you understand these statements, the next step is valuation, determining what the company is worth. For beginners, valuation might seem like an intimidating puzzle, but the basic idea is simple. Compare the price of the stock to the underlying value of the business. One of the most popular tools is the price-to-earnings ratio, PE ratio, which tells you how much investors are willing to pay for each dollar of earnings. A high PE ratio may mean the company is growing quickly and investors expect strong future results. A low PE ratio may mean the company is undervalued or that the market expects trouble ahead. The ratio alone doesn't give the answer. It simply raises the right questions. Another useful measure is the price-to-book ratio, PB ratio, which compares the stock price to the company's net assets. There's also the price-to-sales ratio, useful for companies not yet profitable. And dividend-focused investors may look at the dividend yield and payout ratio to judge whether the company can sustain and grow its distributions. Each ratio is a different lens through which to view the same business. None of them is perfect, but together they create a clearer picture. But numbers alone are not enough. Fundamental analysis also requires understanding the company's story. What does it do? What problem does it solve? Who are its competitors? Does it have an advantage that others cannot easily copy, something unique, durable, or deeply tied to its identity? Investors call this a moat, and companies with strong moats often outperform over the long run because they are protected from competitors in ways that numbers cannot fully explain. Management quality is another piece of the puzzle. A great product cannot survive poor leadership. Strong leaders allocate capital wisely, treat employees and shareholders with respect, and communicate transparently. Weak leaders chase trends, overspend, mask problems, and ultimately steer the business into dangerous waters. Reading shareholder letters, listening to earnings calls, and observing management decisions over time gives you insight into the kind of hands guiding the ship. Then comes the broader context, the industry, the economy, and the future prospects of the business. Is the company operating in a shrinking market or a growing one? Is it innovating or falling behind? Are new technologies threatening its relevance? Fundamental analysis invites you to see the company not just as it is today, but as it may become tomorrow. And this forward-looking perspective is what separates thoughtful investing from blind speculation. All of this leads to one of the most important lessons for beginners. Fundamental analysis is not about predicting the future with perfect accuracy. It is about understanding the present with clarity. When you truly understand what a business does, how it makes money, how stable its finances are, and whether it has room to grow, you gain the ability to judge whether its stock price is fair, inflated, or undervalued. Price is what you pay. Value is what you receive. The art of investing is learning to see the difference between the two. But the hardest part of fundamental analysis is not the math, it is the patience. Real value often takes time to be recognized. Markets can remain irrational longer than you expect. A great company may be ignored today, only to become a market darling years later. A struggling company may appear strong on the surface until cracks begin to show. Fundamental analysis teaches you to trust the quality of the business more than the noise of the moment. It teaches you to anchor your decisions in understanding rather than impulse. And it teaches you that every investment is a story, but before you buy the story, you must read the pages hidden behind the price chart, because the truth is that learn that the market's excitement or panic often has very little to do with the company's true worth, and that real value reveals itself only to those patient enough to look beneath the surface. And as you continue from that thought, you begin to realize that fundamental analysis is ultimately an exercise in separating appearance from reality, learning to see the business for what it truly is, not what the crowd insists it must be in the moment. When you commit to valuing a company through fundamental analysis, you start to view investing less like a gamble and more like a craft. You become someone who looks past the daily price swings and asks deeper questions. Is this business resilient? Is it adaptable? Does it have room to grow? Does its leadership make thoughtful, long-term decisions? These questions shift you from reacting emotionally to acting intentionally. Markets may swing wildly, but a well-understood business remains steady in your mind, allowing you to stay grounded when others lose their balance. One of the greatest advantages of fundamental analysis is that it gives you conviction. When you invest in a company based on true understanding, its cash flow strength, competitive advantage, financial discipline, and long-term prospects, you no longer panic at every dip or correction. Instead, downturns can become opportunities because you are not guessing, you are building on knowledge. Conviction is not stubbornness. Conviction is clarity. It is the quiet confidence that your decisions are rooted in analysis, not emotion. As your skills grow, you also learn the humility that fundamental analysis demands. No matter how much research you perform, the future always holds uncertainty. Even strong companies face unexpected challenges, new competitors, economic shifts, regulatory changes, or technological disruptions. Fundamental analysis does not eliminate uncertainty. It equips you to navigate it wisely. It helps you judge whether a setback is temporary or structural, whether a decline reflects fear or reflects genuine deterioration. It gives you tools, not guarantees. A powerful lesson emerges here. Valuation is not about finding perfect answers, but about making informed judgments. Two investors can analyze the same company and arrive at different valuations, and both can be reasonable. What matters is not precision to the decimal point, it is understanding the range of value, the underlying assumptions, and the margin of safety you require before committing your capital. A margin of safety is your shield in uncertain markets. It is the space between the price you pay and the value you believe the business holds, allowing for mistakes, surprises, and imperfect forecasts. As you gain experience, patterns begin to reveal themselves. Companies with stable earnings, strong moats, disciplined management, and consistent cash flow often outperform over the long term. Companies built on hype, weak balance sheets, or unsustainable excitement often collapse under scrutiny. You begin to recognize signs of strength and weakness not by chasing tips or reading sensational headlines, but by calmly studying the fundamentals. This shift from noise to knowledge is one of the most liberating transitions an investor can experience. But fundamental analysis also teaches you patience in a deeper sense. Even when you identify a great business, its stock price may not reflect its true value immediately. Sometimes it takes months, sometimes years, for the market to recognize what you already see. During that waiting period, doubt can creep in. Others may question your choices. You may question them yourself. But when your analysis is sound, patience becomes your advantage. The market eventually weighs the truth, even if it votes emotionally in the short term. Eventually, you begin to appreciate that valuing a company is not just a financial exercise, it is a way of thinking. It trains your mind to recognize real substance in a world obsessed with surface impressions. It teaches you to look for durability instead of trends, for leadership instead of noise, for discipline instead of drama. It shapes you into an investor who moves with intention, not impulse. And as you carry this mindset into each new investment, you find yourself becoming calmer, clearer, and more deliberate. You stop chasing every headline. You stop fearing every dip. You stop feeling pressure to act simply because others are acting. Instead, you move at your own rhythm, a rhythm rooted in understanding. So, as this chapter closes, hold on to this truth. Fundamental analysis is the bridge between confusion and confidence. It empowers you to see companies as living systems, not symbols. It helps you build a portfolio grounded in logic rather than luck, and it allows you to step into the market not as a gambler, but as a thoughtful partner in the future of businesses you believe in. If this exploration has deepened your understanding, if it has helped you see investing not as chaos but as a craft, I warmly invite you to share your reflection. Your thoughts help me understand what resonates most deeply with you. And if you'd like to continue learning together week after week, feel free to subscribe or follow so we can keep uncovering the timeless principles that help ordinary people become extraordinary investors.